Welcome back to Intermediate Chapter 4. And in this video, it's going to be very short. We're just going to talk about the earnings per share and comprehensive income. There was already a video for Chapter 4 where we refreshed on the income statement, and then we will finish out with a third and final video on the statement of cash flows. So make sure that you subscribe so that you don't miss any of the intermediate accounting chapters, because we're going to walk all the way through to Chapter 21 together. All right, so earnings per share is an amount, is a formula that is used a lot to determine how well a company is doing. And investors love to use earnings per share to compare one company from year to year, and also to compare a company to other institutions whenever it comes to making investment decisions. So we're going to look at that, and we're going to see what the formula is, see what it's used for, and then we're going to look at an example. So earnings per share, you'll see it EPS. Whenever you look up a public company, it will typically say EPS, and you'll be able to determine it that way. So all we do is take net income minus the preferred stock dividends, because here we're looking at how much do those common shareholders bring to the table. So we're going to subtract out anything that is designated to the preferred shareholders, and then we divide it by the weighted average number of common shares outstanding. We're going to touch on this a little bit in this chapter, and then in Intermediate 2, we do dig into it a lot more and it gets more complicated. So let's just talk a little bit about what it's used for, then we'll see an example. So it is a key financial metric that's used to measure the company's profitability per share of common stock. It informs the investors of the profit of the company earned with the per outstanding share. So if you think about it this way, these investors have put money into the company, and they're like, what are you doing with my money to earn more money? Because that's the whole idea. I wanted to put my money into your company. And then my money will earn more money. So please use my investment to earn more money for both of us. So this helps them to see, for all of that money that came in from the investors, how much are we making from it? So we want the number to be high. The higher, the better. So it helps us to evaluate the profitability. It compares, again, different companies. You may have a small company compared to a big company. When we look at earnings per share, it can help us to see how are they using that income to make a big difference. And assesses growth trends. How has the earnings per share increased over time? Has the company done a good job with the investors' money at making profit off of it? So our example here, we have $550,000 of net income, and $50,000 was designated to preferred stockholders. So we have a numerator now of 500,000. The weighted average number of shares. So there were 100,000 shares outstanding for the whole year, started on January 1st. Then they issued another 100,000 shares, but the weighted average has to do with when were they issued. So this says they were issued in the 9th month. Or in the 9 out of 12 months. So January, February, March have already passed. So these second 100,000 shares were issued in April. So they were only outstanding for 9 out of 12 months. So 100,000 of those shares were outstanding from January 1st to December 31st. The other 100,000 just April 1st to December 31st. So that's 9 out of 12 months, which would be 3/4, right? Be 0.75. So that means when we calculate that, that's like having a weighted average of shares of 175,000. So when we divide those, we get the earnings per share of $2.86 per share. That's how much each of these shares have earned for the company. That's how well they're doing at bringing in money. So then we compare it to other companies. We compare it to the same company over many years to see how have they been performing. And the higher, if we see it increasing, the better. All right, now we're going to talk a little bit about comprehensive income and how it differs from just net income. So this is the total change in equity. So we know equity is going to change based on things that have happened from revenue and expenses and gains and losses. So the total change in equity that did not come from owner transactions. This did not come from people just investing in the company. So comprehensive income is our net income, everything we see on the income statement, plus other comprehensive income, OCI. So in OCI, there are four main categories: foreign currency translation, unrealized gains and losses, pension plans from the adjustments, and there could also be derivatives, and I don't have this on here. But what we really are going to talk about during intermediate is going to be the unrealized gains and losses and the pension plans, and those will primarily be talked about in intermediate too. But it's good to just know what they are here, what would fall under other comprehensive income. And basically that portion there, the other comprehensive income, are things that are not, they have not actually happened yet, but we know they're going to affect us. So we need to go ahead and report it. So that shows all of the things that are going to make changes to the equity section that are not owner related. So let's look at an example. So for this company, we have our revenues and gains, and then we have our losses. So our net income was $750,000. Then we have below that other comprehensive income. We've got gains on securities, we've got loss on the projected benefit obligation, which is pensions, and then we have that foreign currency translation. So we had two losses that netted out to $50,000, and then we had a gain of $70,000. So we net out at a gain of $20,000. So while our net income from all of our business operations and gains and losses was $750,000, we add another $20,000 to get to our comprehensive income, and I'm going to show you how that's split up on the equity section of the balance sheet in just a minute. But the way that you would show comprehensive income is you could do it in a single statement like we just saw, like this right here. We've got the income, and then right below it, you've got other comprehensive income. So a single statement, or you could do two completely separate statements. You could have just the income statement and then separately the statement of comprehensive income. You could do it that way as well. Either of those are totally acceptable. So what happens to other comprehensive income? It does not roll into retained earnings. Net income rolls into retained earnings, but accumulated other comprehensive income is where our OCI goes. So this is a whole mouthful, okay? Accumulated other comprehensive income, AOCI, shows up on the equity section of the balance sheet if we do have anything happening in other comprehensive income over the life of the company. So this is actually going to be added to the equity section of the balance sheet. We close out other comprehensive income accounts into accumulated other comprehensive income, and it's going to show up down below retained earnings in the balance sheet. So last slide we'll look at before I shut this one down and we do our final video for chapter 4 is journaling and presenting other comprehensive income into accumulated other comprehensive income. So, we close out our revenue and expenses, our gains and losses into retained earnings. This is the closing entry. The top thing here is the closing entry for accumulated other comprehensive income. Remember, these are the three we had. We had a gain on debt securities. Well, any kind of gain sits as a credit. To get rid of it, we need to debit it. Our losses on these two, those always show as a debit, just like expenses. We credit those to get rid of them. And the difference, that $20,000 net, we're going to be crediting accumulated other comprehensive income. So this will help us to be able to start at zero going into January 1st, going into the first day of the fiscal year. So we get rid of that normal credit balance for the gain, get rid of the normal debit balance for the losses. The net goes to accumulated other comprehensive income, which, as you can see down below, we've got our balance sheet, we have our total assets and liabilities. Our shareholders' equity is going to show common stock, retained earnings, and then accumulated other comprehensive income. So we've closed it out there, and then on the comprehensive income statement, we'll be able to see zero balances when we start the new year, and that's where those will be reflected. Not every company has accumulated other comprehensive income, but many of them do, and I know that's not something that's been talked about a lot up until this point, but hopefully this helps. Right now, you just need to have a grasp of what it is. Later, you'll get more of an understanding of what those different gains and losses mean and where they come from.